In this week's market update, central banks and US politics are in focus in an otherwise quiet summer holiday week, and markets drift lower as geopolitics and another terrorist attack dampen sentiment. The summer meeting of central bankers at Jackson Hole in Wyoming always gets plenty of coverage in the media for a couple of reasons. First, with interest rates and monetary policy having been the market's principal drivers since the financial crisis, a gathering of the world's main rate setters has the potential to signal key policy shifts. The second reason, of course, is that the end of August is silly season in newsrooms, many people are on holiday and nothing much is happening. With traders' eyes focused on Jackson Hole, equities and currencies are in a holding pattern this week. Attention is on both Janet Yellen's press conference on Friday and any new indications from ECB President Mario Draghi. He's expected to provide further insight into the European Central Bank's approach to monetary policy in the Eurozone as the region moves deeper into its economic recovery. The ECB has already started the process of reining in quantitative easing, reducing its monthly bond purchases from 80 billion euros to 60 billion. With deteriorating availability of suitable bonds for the bank to buy, QE may have to be pegged back further, even if the fundamentals of inflation and growth are not yet signalling the need for tighter policy. This year's Jackson Hole Symposium presents the opportunity for the world's main central banks to offer a coordinated vision of the post-crisis world. While inflation in wages and costs may not be evident, QE has clearly driven inflation in asset prices. 10 years on, the risks and imbalances of a decade of easy money are beginning to show. The great unknown is how investors will take clear evidence of a concerted tightening against an uncertain backdrop of geopolitical risks and a lack of leadership from a chaotic White House. The past week provided further evidence of that as Donald Trump's chief ideologue, Steve Bannon, became the latest senior presidential aide to fall on his sword. The former naval officer and Goldman Sachs banker is better known these days as head of the alt-right website Breitbart, where he's returned to promote his nationalist agenda from outside the White House. His right-wing views have become increasingly toxic in Washington over the past week. It's been another volatile period in the US Capitol as the president has come in for widespread criticism for his apparent support of white supremacists, objecting to the removal of statues of pro-slavery Confederate leaders from the American Civil War. The row over Donald Trump's refusal to unambiguously condemn neo-Nazi elements following the murder of a counter-protester in Charlottesville and the continuing upheavals in the White House have hung over markets in the past week. The gloom has built on the uncertainty created by the now partially resolved standoff between the US and North Korea. Pressure on the president deepened as one by one the leaders of America's biggest companies withdrew their support in protest against his position on the Charlottesville affair. They resigned from two key business councils. Finally, in a bid to stem the flow, Mr. Trump disbanded the forums while he could still do so and retain at least a semblance of control. So US stocks were under pressure at the end of last week, and that followed their worst single day in several months on Thursday. Market falls have been widespread, with the S&P 500 of course grabbing the headlines, but behind the scenes other key indices like the Russell 2000 Small Cap Index turned negative for the year as a whole, effectively drawing a line under the so-called Trump trade that followed last November's presidential election. The small cap index is seen as a barometer of domestic business activity and sentiment. Sentiment generally feels like it is sagging as the summer rolls on. Ray Dalio, head of the giant hedge fund Bridgewater, said this week that he was reducing risk exposure thanks to the ongoing divisions in Washington. Meanwhile, Societe Generale's Andrew Lapthorne added that share buybacks, which have been a major support of the market, have fallen 20% as companies have reached the limit of how much they can borrow to support their shares. And Matt King at Citi noted that central bank stimulus has had a much greater impact on asset prices than on the economy over the years, and so asset prices will likely suffer as easy money is withdrawn. While the top-down view of markets might be negative, therefore, looking from the bottom up, things look more encouraging this week. Having seen company earnings rise strongly during the second quarter, the latest evidence on the dividend front is also pretty positive. A return to dividends by banks, held back in recent years by stress tests and increasing capital demands from regulators, has driven an acceleration in dividend growth around the world. Underlying dividends, excluding special payouts, rose by 7.2% in the 3 months to the end of June, according to Janus Henderson's latest Global Dividend Index. Financial companies accounted for half of all dividend growth in the quarter, with banks up 9% year on year. Regulators gave US banks the go-ahead in June to pay out almost all of their earnings to shareholders if they chose to do so, an estimated total of almost $100 billion from just the 6 largest banks. In Europe, 86% of companies either raised or held their dividends in the period, and the UK did better than expected, with growth of 6.1% thanks to much better than expected payouts in the mining sector. Glencore, for example, restored its dividend. Meanwhile, in Asia, attention is focused on capital growth, as strong earnings growth from China's leading technology stocks has seen the value of both Tencent and Alibaba rise by more than 70% year to date. That has propelled the 2 internet giants into the world's top 10 companies, measured by market capitalization. They're ahead of corporate titans Johnson & Johnson and ExxonMobil, which was once the world's largest company and now barely makes the top 10. China's increasing corporate influence was also highlighted this week by confirmation that Great Wall, the Chinese car maker, is seeking to buy Fiat Chrysler, its US-Italian rival. Such a deal would undoubtedly meet stiff opposition from a more protectionist US. The company actually is not averse to a deal. In fact, it's already made overtures to both General Motors and Volkswagen as it seeks to gain access to the finance required to compete in the new world of electric and self-driving cars. But a takeover by the Chinese would be an altogether different option than a tie-up with an American or European partner. Despite the entry of 2 Chinese companies into the top 10, the world's biggest companies continue to be dominated by US technology companies, with the top 5 slots taken by Apple, Google owner Alphabet, Microsoft, Facebook, and Amazon. The decline of Exxon among the world's biggest companies reflects the slide in the oil price over the past 3 years. Oil has flatlined around the $50 mark for most of the past year or so, since recovering from its January 2016 low. Although at the end of last week, the Brent contract enjoyed its best day in more than a month, up nearly 4% to $53 a barrel, as stockpiles in America dwindled on the back of strong exports and end-user demand. Also stagnating at the moment are UK house prices, with the latest projections from the countrywide estate agency pointing to growth of just 1.5% this year. That's well down on the past year's 5% growth. Looking further out, the agent expects growth of 2% in 2018 and 3% in 2019, as a slowdown in the London market ripples out to the rest of the country. Separately, the Royal Institution of Chartered Surveyors said that its housing indicators were at their weakest since 2013. Transactions have dwindled on the back of falling inflation-adjusted household earnings, an inability of first-time buyers to get on the housing ladder as prices have run away from salaries in recent years, and increases in stamp duty levied on buy-to-let property buyers.